When you measure gold monthly action, monthly bars, like a price chart, but we measure them versus a 3-year average or 36-month average, and we plot them as an oscillator, meaning, okay, this month's high, low, and close are how much above or how much below that changing average. And it ends up, you have an oscillator. It goes above the zero line, it goes below it in bear market, et cetera, et cetera. Nothing structurally in terms of defining the trend or momentum is even threatened right now in terms of breakage, downside breakage.
Okay.
We see all the evidence here that this pause in gold, 4 months now, total boredom, is about to launch again, and it probably will launch next month, my best guess. Now, look what's uniquely happened, though, in the last 4 months. While gold has gone sideways and yawning, not going down, but just sideways.
Yep.
Silver's gone up explosively. We've gone from the upper 20s to the upper 30s in that 4-month period. The two things that went up most obviously were T-bonds, up in price, down in yields, long-term T-bonds I'm talking, and gold related. This is the stock. The gold has already been underway for 10 years upside. It has major cycles, and what they're really dependent on is not some headline here or there or some market here or there, but on the overall onward decay in the money unit, the dollar.
Right.
I don't mean the dollar versus the euro or the yen. I'm talking about the dollar's real buying power. So when I was a kid, a loaf of bread was 20 cents. Okay, it's not anymore. Okay, it's because the decay in the dollar, not because of increase in bread prices. The real value of the dollar, you lose, it increases in quantity, M2, for example, almost doubles every decade. Huge, almost doubles every decade. The population doesn't double every decade. But anyway, and now recently, the last 10, 15 years, it's gone up even more steeply. You look at an M2 chart from Federal Reserve and you'll see it.
Since bottoming out near 1,050 in late 2015, gold has risen steadily, crossing $3,400 recently without a single major momentum breakdown. Analysts tracking long-term monthly price trends using momentum oscillators confirm the uptrend remains strong. These indicators, based on gold's performance relative to a 36-month average, have not flashed any bearish reversals. What we're seeing now is a 4-month consolidation, a quiet before a likely storm. The setup suggests an imminent breakout. Gold hasn't weakened, it's gathering strength. Investors should view the current pause not as hesitation, but as a coiling spring preparing for the next leg upward.
Well,
right.
So naturally, prices of things go up because the value of the dollar goes down in real buying terms. It takes more dollars. So people that cheer, for example, the stock markets, it's stock market, got to be there, it's always making money. Let's go back 25 years, throw a dart. July of 25 years ago, the July 2000, S&P's more than tripled since then at current price levels. More than tripled. Sounds good, huh? Gold's gone up 11-fold. Okay, 11-fold.
Right.
Okay.
Right.
Now, if you flint return, no, you didn't get the 11-fold gain, but it's gone up 11-fold with definable bear markets in between that we've defined. And right now we turned bullish on gold in February 2016, 2.5 months off the bear low, which was 1,050. Right now we're 3,400 area. Nothing since then in that 10-year period has altered our annual momentum trend analysis of gold. And that's what do we mean by that? It's when you measure gold monthly action, monthly bars, like a price chart, but we measure them versus a 3-year average or 36-month average, and we plot them as an oscillator, meaning, okay, this month's high, low, and close are how much above or how much below that changing average. And it ends up, you have an oscillator. It goes above the zero line, it goes below it in bear market, et cetera, et cetera. Nothing structurally in terms of defining the trend or momentum is even threatened right now in terms of breakage, downside breakage.
Okay.
We see all the evidence here that this pause in gold, 4 months now, total boredom, is about to launch again, and it probably will launch next month, my best guess. Now, look what's uniquely happened, though, in the last 4 months. While gold has gone sideways and yawning, not going down, but just sideways.
Yep.
Silver's gone up explosively. We've gone from the upper 20s to the upper 30s in that 4-month period.
While gold has treaded water lately, silver has surged, rising from the upper 20s to the upper 30s in just months. Even more striking, mining stocks have outpaced gold itself. This reversal of leadership is historic. In past cycles, such as the 2001 to 2011 bull run, silver and miners took the reins before gold went parabolic. GDX, the gold miner ETF, is breaking out when charted against gold. This shift marks the early phase of acceleration in the broader precious metals market. When the miners and silver led, gold tends to follow dramatically. This is not just rotation, it's ignition.
And if you look at GDX, for example, it's risen sharply as well, while gold stood still. So it used to be the other way around for the last several years. Since that 2020 upshot we had in gold, the miners and silver, it peaked basically in mid 2020. Gold had a range-bound situation, 20% to high-low, but silver and the miners tended to retreat more.
Right.
But arduous. They get nice rallies, but it'd be a zigzag to the downside while gold went sideways. That is shifting. It's shifted in the last several months, especially since April, where the miners, if you plot them as a spread, meaning divide the price of GDX into gold ounce, express it as a percentage, and plot that chart.
Yeah.
And you'll see that it's broken out over trend structures that are easily defined when you plot that spread. Downtrends, horizontal lines, etc. So, and the same with silver. So what it argues to us is that, okay, now we've entered the phase where those parts of the monetary metals complex will lead gold. This has happened before, and usually when it happens, it's quite dramatic. In fact, if you go back and look at that bull market in 2001 to 2011, in 2010, silver went vertical, while gold continued up, but silver exploded geometrically.
Right.
And we're at that phase now. In fact, if you even just look at a price chart of silver, any of your watchers, just go look on your quote screen and get a silver futures continuation chart, meaning it rotates to the next active contract. Okay. Go back to the 2022 low. Remember that low? That's when we paused from 2020, 2021, and it was flush in gold. It took it from like $2,000 down to $1,620. Well, silver also went down then, made a low. Miners, same story. If you plot the action since 2022 low, which would have been like August, September of that year, you could plot a parallel uptrend channel on price even. You've emerged through the top of that. Yeah, an upward bull market, but at a definable angle of recurring rallies and lows that just stay in the tube, and frustrate people because you get these sell-offs in the tube, but it's still rising. They forget to see that.
Silver has officially broken above a 2-year upward trend channel, with price now comfortably sitting above previous resistance. Chart technicians note that silver's move resembles its behavior before the 2011 surge when it rocketed to $50 per ounce. But in today's dollars, adjusted for inflation and monetary debasement, $50 is no longer impressive. We may need to see $200 silver just to match 1980's real value. A move towards $60, $70 seems conservative. The current breakout isn't speculative hype. It reflects growing global distrust in fiat systems and increasing industrial demand. This could be silver's defining decade.
We've blown through the top of that. We did that about a month ago, and after doing it, we've paused. But we're above the channel top and comfortably quiet. So we've had a breakout, even evident on price, much less momentum, which already broke out before that. So I think we're headed to, pardon me, my camera is moving.
All right.
I think silver's has entered now that acceleration phase. Our expectation is this, and it's not outlandish. The $50 highs we saw in 1980 and 2011 in silver Think about how much time has passed. Well, the decay in the money, even since 2011, has been enormous.
Yeah.
So even just to get back to 50 isn't getting back to 50 in real dollar terms. We probably have to go to $200 silver just to match the 1980 peak, at $50. Okay.
Right. Right.
I think we're going to go to $60 to $70. There was below the $50 highs out, what I call idiot highs, because they really don't mean too much, especially in real terms. And do that this year in this surge that we've now commenced.
This
Now,
year?
This year, meaning in the next 5 months or so. There might be a pause there, I'm not sure, but I think at least we're going to blow out to 50 and not even pause till we're credibly beyond it. Now, is that the end? No. We're in a different situation now. I think you know it. Eric Sprott knows it. A lot of people know it. This isn't just another gold silver bull market. This isn't just 1980 and then it's over and you go down to hell for the next couple of years, or 2011 and you go down to 2015. There are things going on out there that are far more disastrous, pending, and already commenced, that will impact monetary metals. We don't call them precious metals. Platinum's a precious metal. Gold is a monetary metal. So is silver.
Treasury bonds, especially long-term 30-year bonds, are failing to deliver during stress periods. Even as central banks cut short-term rates, long bonds remain weak, choking under the weight of systemic debt. Unlike in 2000 or 2008, this time the crisis isn't limited to housing. It's government, corporate, and consumer credit combined. Commercial real estate is suffocating under higher rates. Consumers are missing tax deadlines and maxing out credit cards. When the next major downturn hits, central banks will respond with unprecedented liquidity. But this time it won't lift bonds. It will lift gold and silver, the only assets signaling what's ahead.
And that is that when that shit hits the fan, pardon me, you have to edit that out. The central banks will go more berserk than they have ever been. Because not only will stock market go down, but all the data points they like to chatter about, how, job market's looking good, which it really isn't when you look at the inside data. But once the market starts down, if you go back and look at the 2000 top to the 2002 low, 2007 top, 2009, all the data points that they like to chatter about really started to go south in an obvious way once the stock market topped.
Yeah.
And started down. And finally, people started pulling their hair, and there were the CEO says to don't hire any more employees this month. We're on pause or lay them off. And all of a sudden, the data points will shift. That's when the central banks will go ape. And they always do. They always do. If you go back and look at those two tops, you'll see they started cutting rates like crazy. It didn't help the stock market. What helped? Two markets went up during that time, gold and T-bonds. Question now is T-bonds. You mentioned that.
Yeah, please.
Yeah. Well, the T-bonds they're not responding to the Fed. They usually don't, because it's the long end of the debt market. We're talking 30-year T-bond futures, okay, not the 90-day stuff.
This isn't just another cyclical rally. It's a global monetary shift. Gold and silver aren't reacting to news. They're anticipating systemic failure. Central banks already loosening policies will go full throttle as economic data turns sour. As markets fall, layoffs rise, and credit dries up, gold is the only asset still outperforming. T-bonds aren't working. Stocks are vulnerable. Portfolio managers are watching. When capital flees risk, it searches for reliability, and gold is delivering. From 2015 to now, gold has outpaced stocks and beaten inflation. The world is waking up to the reality. Monetary metals aren't precious. They're essential.
When the Fed cuts rates like they did, back late last year, a couple times, took it off the high, the recent high, shallow high, by the way, in terms of rates historically. T-bonds went down in price, up in yield, despite them cutting rates. And if you look at a T-bond futures chart or a yield chart, which is the opposite, of course, they're clustered. T-bond prices are just laying on the floor, anemic looking, despite even during that drop in April in the stock market. Didn't help the bond market. They tried to go up in price. There was a nice rally into early April, but then they collapsed. And they're just laying here a point or two off the floor of the last, actually, several years. So the long-term rates are choking, and they're not letting loose. The noose is not getting looser. It's just as tight as it was 2 years ago, which means there's a lot of big corporations, especially commercial real estate, and plus the government is hurting because of this. So we don't just have a mortgage problem like we did in 2007 to 9. Now suddenly it's government debt, not family mortgage. We all know that there's credit card excesses, by the consumer. They're at their limits. They're past due. We also know there's a lot of late filing of taxes now, increased sharply. People just can't pay it, so they delay or they try to set up a plan. Something's hurting already. But when it becomes bleeding obvious to the central banks, gold already knows this is going to happen. Mm-hmm. That's why it's not sitting and waiting for the bad data points for the Fed to cut. It's already on its way. It knows. And not just the U.S., but the Japanese have been doing it, and we know the EU will too. So that's the dynamite. So we watch the stock market because it's going to have an impact on the central banks, but also money flow. If people get out of the stock market, they go somewhere. And they usually go to those two things. But if you're a portfolio manager and you're looking at gold and T-bonds ain't working. Only gold's been working. Gold's up, despite the pause, is up a lot more than the stock market this year, the last 3 years, the last 10 years even. You go back to 2015, gold's beating, anyway.